right, very good. So you can start the timer. It's a pleasure to present this little survey of our work, mostly with Professor Sandy Pentland from MIT, but also on my own. So the question is, we saw some pretty remarkable defaults in the US banking system, which eventually propagated towards other parts of the world. And the question is, why did they happen? How can we address them and make sure that going forward there is less of a possibility of things like that? So I am going to cover a little bit of this plan, but given how delayed the whole thing is, that probably I will not cover everything. So my idea is that social media panics caused flash crashes that bankrupted Silicon Valley Bank and many others, and wobbled some of the bigger players outside. And why is it happening? How can we address it, and so on? Right. So the first question actually goes to the 13th century. It can be found in the book by the Italian mathematician Fibonacci. We all know Fibonacci numbers. And if you read what he asks is that there is a certain interest rate, you put some money into a bank, how much you should be taking out every year in order to exhaust all your money plus interest. What is interesting here is that the actual interest which he operated in the 13th century was 20%. And this is a standard Mediterranean interest rate, which goes to the Sumerian times, and 12 shekels per mina per year. That's what it is. So as we will see, interest rate plays as much a role in this debacle as the social media. Right. So if you want to know the answer to this question, ask me later on. And by the way, in reverse, that's a calculation from the 13th century is being used in the US mortgage market when they calculate 30-year mortgages, which tells you how archaic and actually dangerous this product is for the financial system. So this is taken from the information provided by the Bank of England and shows historical long-term rates. So they conclude from this picture that rates actually go down and so on. I drew a completely different conclusion, that 5% interest is natural and should be preserved. And here what the Federal Reserve did instead, this graph covers the mighty PowerPoint somehow converted voluntarily the formatting, date formatting to something else, but it starts at 1954 and continues to our days. And you can see that from 2008, the interest rate was kept unnaturally low. In fact, horrendously low. And that actually brings us straight to the collapse of the Silicon Valley Bank, which basically was a rather healthy and chirpy bank, 16th largest bank in the United States by the 31st of December 2022. And quite opposite to what we heard about Wirecard and so on and so forth, it was not a fraudulent organization at all. We can see that their assets and liabilities, they're nicely balance each other. And what is particularly important is that the bank had 121 billion worth of bonds kept to maturity, and about 16 or 18 bonds which were available for sale. And then something really magnificent, and everybody knew this. This is absolutely no kind of information which was hidden, which was misinterpreted. Everybody and his uncle, or her uncle, better to say, knew about that, right? Then suddenly, this drew attention from a completely obscure, newsletter, right? So it was published in February of 23, which was a Thursday, and it declared that if all the bonds kept to maturity were to be sold, then there would be enormous losses. Why would that be the case? Of course, because the bank was actually forced, more or less, quote unquote, to buy longer dated bonds in order to get some some net interest income. And of course, you can say they should be hedging it, etc., etc. That's actually not the right take, because the bank cannot hedge all the risks, because if they were to do that, there would be nothing left. Okay, and then on February 28th, which is a Tuesday, the CEO of the bank actually sold 4 million worth of shares. That was a very bad, and by the way, at that time, the bank value was $289, then it became $288. So this selling of shares was a fishy proposition, quite frankly, because even though he filed a permission to sell shares, it was filed 1 month before the actual sale, and everybody who has any kind of common sense at all should at least wait for, the regulation have to force them to wait at least for 90 days, if not for half a year, because otherwise it becomes a tool for market manipulation. Anyway, so on March 1st, Moody informed SVB that they will downgrade their credit rating. By the way, pay attention to the fact that essentially credit ratings of banks are completely useless, because on the 1st of March, this was a bank in very good standing, and etc., etc., and the value of the stock started to cripple down a little bit to 83. And then on March 10, which was a Friday, on March 8, which was a Wednesday, Moody actually did downgrade the stock. The price went to 268. Then the topic of what we are discussing now started in earnest. There was a Twitter storm on Thursday, March the 9th. The stock went down quite dramatically and stopped there, essentially. And all kind of VCs who are prominent in the valley, including, for example, Thiel and others, were telling the portfolio startups to take the money out. In the interest of full disclosure, I have to say that one of the companies which I co-founded did have account with Silicon Valley Bank, and we did run into the impossibility to actually do the payroll on Friday. Thanks God, like the U.S. government, bailed us and everybody else out. So anyway, so on March 10th, the bank was shut down and took over by the California regulator. So that's the story of the collapse in a nutshell. All right, and so this is the role of social media. You can see that there was absolutely no interest in this bank until this, this March, whatever, 2nd, 3rd, and then it went up dramatically. And the most interesting thing to me personally is the US was not the most interested part of the world. Singapore, which is known for its astuteness, has been the most interesting. One date which is not shown here, but should have probably been, is that on March 1st, I had a conversation with the CEO of a prominent stable coin company. And right here in Abu Dhabi, in actual fact, at SALT Investopedia conference. And I told this gentleman that because his money collateral is held by the banks, the coin simply cannot be stable. It's an oxymoron. You cannot use a stable coin based on that stable banking system. Of course, I got pushed back, and I was convinced that I'm wrong and that it is stable. Needless to say that this particular stable coin had $3 billion with Silicon Valley Bank, and of course, on the 9th of March, the peg one-to-one was broken. Seldom, I have to confess, my predictions came with such fluidity. Right? And so the role of social media, if we summarize it, this is the first Twitter-fueled bank run, as said the House Financial Service Chair, Patrick McHenry, and there are two main reasons. How quickly news of Silicon Valley Bank impeded collapse circulated, and how easily the clients could took off the funds. And here is the Magnificent Three, the Silicon Valley Bank, and a couple of others, and you can see that in fact speculation put the price of Silicon Valley Bank 2 or 3 weeks before its complete demise by 40% up compared to the beginning of the year. So that much is for the rational market hypothesis. I have to say, anyone who spent more than 5 years in financial markets knows that this hypothesis is simply nonsensical. However, academics continue to push it through, presumably because they don't want to spend any money, any time working for financial institutions. It's quite obvious. These graphs show you once and for all that this rational market hypothesis is simply a figment of some academic imagination, right? So these are the highest losses, and you can see when it rains, it pours. So there are, losses which occur in 2008. So Washington Mutual is the biggest. Then there is a trio of these banks which we looked, including Silicon Valley Bank, Signature Bank, First Republic, and all that. Then there are a few others from the great financial crisis, and most of the smaller ones are coming from the savings and loans debacle. So now, why is these things happening? So part of the equation is that the Federal Reserve went up and up and up and beefing up its balance sheet. As a result, as you can see, the proportion of the balance sheet of the Federal Reserve compared to all the money held by private banks became 40%, which means that it became a very big player in the field where they shouldn't be played in the first time. And, of course, you can see what are the consequences of that, right? The Federal Reserve was founded in 1913, and until 1922, it never had a loss. First World War, Second World War, Pearl Harbor, this and that, never lost. But in 2022, they started to accumulate enormous losses at a rate of 2.5–3 billion per week. And now you can see that they owe the Treasury about 120 billion, and it will go further down clearly before it clears. The only difference between Silicon Valley Bank and the Fed is that the Fed does not need to declare it as a loss. In fact, it declares it as deferred assets. So as long as you can do this, you are kind of in business, right? And so basically this claim from this popular movie, Napoleon Bonaparte, is I am the first to admit that I make a mistake. I simply never do. The interesting thing is that, of course, reasonable people can disagree whether or not Fed made a mistake. I was claiming from 2008 that, this low interest rates have to be avoided like a plague. Nobody wanted to listen to me, but this is how it is. And by the way, if we go a little further to the movie, you will see this famous scene when, during the Battle of Austerlitz, the French artillery starts to shoot the ice covering the ponds, and 20,000 Russian troops drown. This is an interesting thing. I mention it because, of course, it's the same mistake, and here Ridley Scott should have done it, but he didn't, of course. The point is that in reality, this was a piece of market manipulation. That's what it was, because Napoleon wrote this relation that they drowned 20,000 Russians. It was sent to Paris, which was on the precipice of default. So social media then worked much slower, but equally efficiently. Then, everybody rejoined. The Bank of France was reconstituted in January of 1806. Based on this, news. However, if somebody were to bother and read an article about the debacle at Austerlitz in the Journal of English Historical Journal, published in 1902 by Henry Rose, they would see that Napoleon themselves ordered to drain all the ponds, and in one pond there was nothing found. In the other one, 100 horses, 25 guns, and 2 bodies. Right? So that's how 20,000 became this. So we should be very cognizant that we should be very cognizant that, media can manipulate things massively. I cannot go through all this, but I will sort of go through my conclusions, if you wish, because here are the potential remedy. We need to break commercial banks into narrow and fractional bank, separating daily operation from lending, akin to the Glass-Steagall Act of 1993. Narrow banks should rely on small fees and provide payment, limit large depositor withdrawal amount, which would mirror practices like Blackstone, where the stability means increasing stability amidst social-driven panics, allow banks breathing space to sell illiquid assets, shift regulators. This is very important from the context of this fintech discussion we're having right now. Shift regulators to digitally continuously monitor banks rather than relying on annual audits, enhance oversight and deter risky behavior. Real-time auditing will be really a boon for this type of activity. And this shows on the right, it shows a narrow bank, which basically has all the central bank cash and nothing else, and a conventional bank. And you can read more in this paper with Sandy Pentland, in this paper with Sandy Pentland, this book with Sandy Pentland, and this book with Adrian Tricani. And I actually have reprints of this paper, so if you ask me, I can give you a few on the first come, first serve basis. And that would close my remarks. Thank you very much. I appreciate it.